Welcome to AI Explains, a channel where we ask our AI to break down a variety of complex subjects for our viewers. Please like and subscribe for more videos like these. In today's episode, we'll be talking about what interest rates mean to you, where they are headed, and what AI thinks you should do about it. Interest rates are like the price tags on money. They determine how much it costs to borrow money or how much you earn on your savings. When interest rates are high, borrowing becomes more expensive and saving becomes more rewarding. Conversely, when interest rates are low, borrowing becomes cheaper, but savings yield lower returns. These fluctuations in interest rates have a ripple effect throughout the economy. They influence consumer spending, business investments, and overall economic growth. Central banks, like the Federal Reserve in the United States, play a crucial role in setting interest rates to maintain economic stability. Think of it as a balancing act. Central banks adjust interest rates to encourage borrowing and spending when the economy is sluggish, and raise rates to curb inflation when the economy overheats. Understanding interest rates is fundamental to grasping how the economy works and how it directly impacts your financial well-being. Since the global financial crisis in 2008, we've witnessed near-zero interest rates globally for quite an extended period of time. This was driven by a desire to stimulate economic growth following one of the greatest recessions in recent history. Central banks, in an attempt to encourage borrowing and investment, had lowered interest rates to make it cheaper for individuals and businesses to access credit. This strategy aims to boost consumer spending and business expansion, ultimately driving economic recovery. However, in the post-COVID era, the world entered a period of sustained elevated inflation. This caused a sharp increase in interest rates to levels not seen for nearly 2 decades. Now, how do lower interest rates stimulate economic activity? When interest rates are low, it becomes cheaper for businesses to borrow money for expansion, invest in new equipment, and hire more employees. Simultaneously, lower interest rates make it more attractive for consumers to borrow money for large purchases like homes or cars, boosting the housing and automotive industries. This increased borrowing and spending can lead to higher demand, potentially driving economic growth. However, it's important to note that this strategy is not without its potential downsides. Declining interest rates can be a double-edged sword for the economy. On the one hand, lower borrowing costs can stimulate economic growth by encouraging investment and spending. Businesses are more likely to expand when they can access capital at lower rates, leading to job creation and increased economic output. On the other hand, prolonged periods of low interest rates can lead to unintended consequences. One concern is the potential for asset bubbles, where the prices of assets like stocks and real estate become inflated due to excessive investment and demand driven by cheap credit. When these bubbles burst, as was the case in 2022, they can have severe repercussions on the economy. Low interest rates pose benefits for borrowers. For individuals and businesses looking to borrow money, declining interest rates can be a boon. Mortgages, car loans, and business loans all become more affordable when interest rates are low, making it easier for people to seek financing. Lower monthly payments on loans can free up cash flow, allowing individuals to save more, invest, or spend in other areas of the economy. This increased borrowing and spending can contribute to economic growth. Remember, 70% of the United States GDP is based on consumer spending. It's essential to remember that when borrowing, even at lower rates, you should always do so responsibly. The not-so-good side of low interest rates. While borrowers rejoice in the era of low interest rates, cash-rich savers often find themselves on the other side of the coin. When interest rates are low, the returns on savings accounts, certificates of deposit, and other fixed-income investments dwindle, making it more challenging to grow wealth through traditional savings methods. This can be particularly concerning for retirees who rely on interest income from their savings to cover living expenses. In such an environment, savers may need to explore alternative investment options that offer higher returns, but may come with increased risk on their life savings. A glimpse into the future of interest rates. Predicting the future of interest rates is a complex task influenced by a myriad of factors, including inflation, economic growth, and global events. As of August 2024, experts believe that interest rates in the United States are on the verge of declining, now that the rate of inflation has moderated to levels acceptable to the Federal Reserve Bank. The pace of interest rate decline remains in question and will depend largely on the coming economic data readings and whether they point to a deeper recession than had previously been anticipated. However, investors now believe that the Federal Reserve is behind the curve and may need to cut interest rates more aggressively to catch up with economic realities. Only time will tell how fast interest rates will drop. In a world of declining interest rates, it's crucial to stay informed and adapt your financial strategies accordingly. If you're considering taking on debt, such as a mortgage or a business loan, you might want to wait for interest rates to drop to more affordable levels. For savers, knowing that your savings and deposit rates are on the verge of a decline, it might be prudent to begin locking in some higher yields through bonds. Consulting with a financial advisor can provide personalized guidance tailored to your financial goals and risk tolerance. Remember, knowledge is power, and understanding the dynamics of interest rates is paramount to making informed financial decisions. This video is for educational purposes only. Always seek professional financial advice. Thank you for watching. Before you go, if you found this video helpful, please give it a thumbs up. Don't forget to subscribe to our channel and hit the notification bell so you never miss an update. Your support helps us create more valuable content for you. Thank you, and see you in the next video.